Welcome to Petra's Family Wealth. Today we're going to talk about snowballs, and specifically Snowball Structured Notes. One thing you'll learn as you get more involved or start to incorporate more structured notes, a lot of times the nicknames are a heck of a lot cooler than the technical terms. So this one's going to be an auto-callable growth note. This one's going to be good for investors that want to have a little bit more conservative posture on their investments, and also for taxable account investors that are looking to transition away from maybe interest and dividends that are taxed, or non-qualified dividends that are taxed at the income tax rate, and want to shift more of their income towards capital gains. If this is the first time that you've checked out some of our videos, I'd recommend taking a pause here, going back, check out our more basic explanations of structured notes, get some of the definitions down, how they all work, and then come back here for some of the more detailed explanations. Before we dive in, I want to share that this is not a recommendation for you and your family. This is a hypothetical, and it's purely meant to arm you, educate you, and help add another arrow to your quiver as you're designing working with your advisor to design an investment strategy that's tailored, handcrafted more towards you and your family. So with that, let's go ahead and dive in. So today I got in front of you here just a hypothetical. And one of the main reasons why this is called a snowball is that the potential return actually increases the longer that the underlying investments are negative. And so I'm just going to go through, hey, what if the markets are positive or the underlying investments are positive at the first year, second year, third year, so on and so forth. And then also what happens if the market continues to struggle for a longer period of time. So again, this one fits primarily for folks that are maybe on the more conservative side. They're not anticipating the market to grow a whole bunch here in the future years, as well as potentially changing or trying to mimic some of the returns of fixed income, but switch it into more of a capital gains format rather than interest. So this one, that's based on the S&P 500, the small cap index, the Russell 2000, and the mid cap index. And it's always typically it's based on the lesser performer, and there's a reason for that, why that might be a benefit in the client situation. But this one's potentially 5 years, and it has 25% barrier protection, which is like a soft protection at the end of that 5 years. And then it also has the potential upside of 12% per year. So let's go through a couple scenarios. So let's say you purchase this today, and there's going to be 5 snapshots on the anniversary, so once per year. And you buy this today, 12 months from now, there's a snapshot. And let's say all 3 of those underlying investments are positive. Well, if that's the case, you would get cashed out and you would make a 12% return. And if it's in a taxable account, that would be a 12% capital gain versus, a typical bond might be interest, which is taxed at your earned income tax rate. But where this really shines is if there's multiple years where the market's negative and then finally comes back up. So let's say you buy it today, fast forward 1 year on that first snapshot. I'm going to pick on the small cap index, and let's say that's negative. Well, then you get to keep it for another year. Okay, year 2 anniversary comes around. I'm going to pick on the small caps again, and let's say that one is negative as well. Well, then you get to keep it, and this continues. And so the most positive outcome in this situation compared to maybe other assets or other investment vehicles is, let's say, not until that 5th year the market is finally recovered, or the worst performer is finally recovered from when you purchased it. Well, then you would make 5 times 12%, so a 60% positive return, even though the worst performer maybe is only up 0.01% from when you purchased it 5 years ago. And so that's where that return keeps building over time, the longer the underlying investments are negative. But the risks are, what if market's positive except for on those anniversaries? Well, then you got to keep the investment until it potentially gets called. But let's talk through a situation where, let's say, the market never recovers. Well, that's where that soft protection, that barrier protection, comes in handy. And so you buy it today, never really recovers. And let's say I'm going to pick on the S&P 500 this time. Let's say the S&P 500 is negative 25% or less. So it could be negative 10%, it could be negative 20%, negative 25%. In your situation, you would actually get all of your principal back. And so you didn't lose any funds. but you didn't gain anything either. So this is kind of an in-between a stock and a bond allocation to try to get us a solid positive return in maybe a flat to slightly up market over the next 5 years. Where we can potentially lose principal is if market's down, we never get called during that 5-year period. And let's say, I'm going to pick on the S&P 500, let's say that is down 26%. Well, that soft protection goes away, and then your principal is down 26%. And so that's why that downside protection goes away, and potentially lose principal on this investment. And so that's why it's not necessarily exactly a pure replacement to a fixed income strategy, and it's not a pure replacement to your growth-oriented assets, but it's something in between where you might anticipate some laggard returns over the next couple of years. This is one way where when the market does finally recover, hey, now you can get recoup and have that nice return when it's called in year 3, 4, or 5. So hope you found that helpful. If you did, please go ahead and like, subscribe, and hit that notification button for some more. Thanks so much.